Hey traders, welcome back to InvestOH. If you are trading the Nasdaq today, make sure you watch this update until the end. We will cover the latest market moving news, key economics events, and the most important technical level that could drive the Nasdaq in today's session. Let's get started.
Imagine sitting in the cockpit of a commercial airliner and you look down at the dashboard.
Okay, I'm picturing it.
Right, so half the lights are flashing this brilliant, reassuring green, basically confirming you are cruising perfectly at altitude.
Nice and smooth.
Exactly. But then the other half of the dashboard is just pulsing this angry warning red, suggesting that maybe an engine is violently tearing itself apart.
Yeah, that's a terrifying visual, honestly.
It is. But that is exactly what looking at the market feels like today. Welcome to the deep dive, everyone.
Yeah, thanks for joining us. It's definitely a wild day out there.
It really is. I mean, we have the Nasdaq extending its losses for a third consecutive session. It closed down 0.43% at 25,476.
Right.
We've got these massive AI software giants suddenly morphing into hardware chip makers. And the technical charts are flashing this totally schizophrenic mix of signals that, honestly, it would give any trader whiplash.
Oh, absolutely.
So, okay, let's unpack this. Because our mission for this deep dive is to cut through all that noise. We have to understand the fundamental mechanics behind this immediate selling pressure before we can even, begin to interpret the institutional footprints on the actual price charts.
Yeah, and I think we need to start by looking at how that selling pressure is highly concentrated. Because, a 0.43% drop on the broader index, it isn't inherently catastrophic by itself.
Right, that's just a normal Tuesday in tech.
Exactly.
Yeah.
But the internal composition of that drop is what has everyone so on edge right now. We are seeing this incredibly heavy distribution, specifically in the technology sector, heavily targeting AI and semiconductor stocks.
Oh, wow.
Yeah, so it isn't just a broad market, risk-off event where everyone is selling everything. It is acute anxiety localized almost entirely within the sector that has basically carried this entire market on its back for the last 2 years.
Right. The absolute darlings of the market are suddenly showing these major vulnerabilities. I mean, just look at Cerebra's system.
Oh, yeah. Brutal.
They just took a massive hit, plunging nearly 20% after issuing weaker than expected margin forecasts.
Yeah, and for a company in the hardware space right now, margin compression feels like, well, it's a massive canary in the coal mine.
It really is. And it makes me wonder, is this a demand side issue where the initial AI gold rush is finally cooling off? Or is it purely a pricing power collapse because the competition is just getting too fierce?
It is almost certainly the latter, and I think it speaks to the really brutal realities of hardware manufacturing.
How so?
Well, in a sector that is currently priced for absolute, unblemished perfection, a weak margin forecast is essentially unforgivable.
Right, because expectations are literally sky high.
Exactly. If margins are compressing, it tells institutional investors that the massive capital expenditures required to build these highly complex systems are either spiraling completely out of control, or companies are being forced into a race to the bottom on pricing just to maintain their market share.
Wow, so they're basically cutting their own throats just to keep customers.
Yeah, you simply cannot sustain tech-level multiples on industrial-level margins. The math just doesn't work.
Which leads us perfectly into the actual bombshell of the day.
Yeah.
The catalyst that is fundamentally shifting the tectonic plates of the tech world right now, and that is OpenAI.
Oh man, the jalapeno news.
Yes, they officially announced their first in-house AI inference chip, codenamed Jalapeno. And to me, this explains exactly why those traditional semiconductor companies are suddenly in absolute freefall.
It completely alters the ecosystem. I mean, think about it. We've spent years watching these traditional semiconductor giants provide the massive brute force computational power required for the training phase of AI, right?
Right, feeding the models the entire internet.
Exactly. But the inference phase, which is the actual execution of answering your prompt or generating an image or writing code that requires a totally different architecture, it demands highly specialized ultra-fast efficiency rather than just raw brute force.
Okay, I look at this OpenAI jalapeno news like, okay, imagine a world-famous 3 Michelin star restaurant.
Okay, I'm with you.
And they've spent years buying all their premium ingredients from a network of local farmers. Those farmers built these massive operations entirely dependent on this one huge whale of a client.
Right, the farmers are the legacy chip makers in this scenario.
Exactly. But suddenly, the restaurant announces they've bought their own land and are vertically integrating. They are just going to grow their own vegetables from now on.
Oh, wow. Yeah.
So the farmers aren't just losing a major revenue stream. Their biggest customer is proving that the proprietary value of the farm itself isn't actually that special.
What's fascinating here is how rapidly these technological shifts rewrite the perception of a competitive moat. And honestly, it's actually even more severe than your analogy suggests.
Wait, really?
Yeah, because the restaurant isn't just growing its own food, it's proving it can grow better, cheaper food, specifically optimized for its own exact menu.
Oh, man. That's brutal for the farmers.
Exactly. OpenAI is looking at the staggering premiums they pay to legacy chip makers for inference processing, and they're realizing they can just capture that margin themselves.
So if you were an investor heavily allocated in those traditional semiconductor companies, the competitive moat you paid a massive premium for was just breached by the very entity that moat was built to serve.
Yes. Which completely justifies the dark cloud hanging over the Nasdaq right now. It's an existential shift, not just a cyclical one.
And what's crazy is that the market's tunnel vision on this AI hardware panic is so absolute that it is completely ignoring macro data that would normally trigger a massive rally.
Oh, you're talking about the oil data.
Yeah. Brent crude oil just fell below $76 a barrel. I mean, that's the lowest level we've seen since the Middle East conflict began.
Right.
And historically, a break in energy prices like that acts as a massive tax relief for the broader economy. I mean, sure, we saw transportation and airline stocks get a localized boost, but it did absolutely nothing to lift the broader index. Why is the market just shrugging that off?
Because cheaper logistics and, consumer relief at the pump, it simply cannot offset the sheer market cap weight of the tech sector.
Right, tech is just too heavy.
Exactly. The anxiety surrounding AI capex and this margin compression we talked about, it's acting like a black hole right now. It's absorbing all the liquidity and attention in the room.
So the oil drop doesn't even register.
Barely registers on the emotional radar of institutional tech managers. I mean, they are currently scrambling to recalculate their entire 10-year discounted cash flow models based on OpenAI's new hardware ambitions. Oil is the least of their worries.
Wow. Okay, so if the fundamental moat is being breached, how is that actually materializing in the price action right now? Are we seeing actual institutional distribution, or is this just, retail panic?
Well, this is where the divide between the long-term reality and the short-term pain gets really interesting.
Right, the classic time frame conflict.
Exactly. Let's look at the weekly time frame first. On the weekly chart, the structural integrity of the Nasdaq is still phenomenally strong.
Okay, explain that. Because it feels terrible out there.
Yeah. I know it does, but since October 2022, we have been in a textbook bullish trend. The index is constantly establishing higher highs and higher lows, and that higher low structure represents a massive multi-year demand zone.
Right.
And crucially, price action remains comfortably above the weekly 21 EMA. That's the exponential moving average. So from a purely long-term structural standpoint, the momentum is undeniably intact.
Okay, I have to push back on that, though.
Sure, go for it.
Is looking at a weekly moving average actually useful right now?
Yeah.
I mean, if OpenAI just fundamentally altered the future revenue models of the hardware landscape overnight, isn't looking at a 5-month smooth EMA, basically like looking in the rearview mirror while driving toward a cliff.
Yeah.
The fundamentals have completely shifted out from under that moving average.
It's a fair challenge, it really is. But you can't just dismiss the weekly EMA because of a fundamental shock.
Why not?
Because the weekly time frame shows us the institutional footprint. Massive funds, pensions, endowments, they cannot unwind their positions overnight without crashing the market. They distribute over weeks and sometimes months.
Oh, I see.
So the fact that the index is still above that weekly 21 EMA tells us that despite the jalapeno news and the Cerebra's margin compression, the heaviest institutional players haven't abandoned the broader structural thesis yet. They are absorbing the selling.
Okay, I see your point. The rising tide is still technically coming in. But when we drop down and look at the daily chart, that tide looks like a vicious rip current.
Yeah, the daily chart is ugly right now.
Right. The index is trading definitively below the daily 21 EMA, which signals acute short-term weakness. And a huge component of that structural damage is what happened on June 23rd, right? With that massive gap down on the open.
Yeah, that gap down is the exact footprint of the panic we were talking about. It indicates that selling pressure was so overwhelmingly aggressive in the pre-market that buyers completely stepped away.
They just evaporated.
Exactly, which forced the market to open significantly lower just to find any liquidity. And compounding that weakness, The daily RSI, the Relative Strength Index, is printing clear bearish divergence.
Which is the real warning sign for you. And for anyone listening who isn't familiar, explain bearish divergence really quickly.
Sure, it's basically when the price of the index is pushing up, making higher highs, but the RSI momentum indicator is actually sloping down, making lower highs.
So the energy behind the move is fading.
Exactly. It tells me the underlying momentum is totally exhausted. The market was coasting purely on inertia, and the moment a fundamental catalyst like OpenAI's chip announcement hit, there were no aggressive buyers left to support the price.
Wow. Okay, so if we connect this to the bigger picture, the conflict between the weekly and the daily charts perfectly maps to the psychological divide in the market right now.
It really does. I mean, a long-term wealth manager looks at the weekly chart and sees a completely standard, healthy correction to a mean.
Right, just a blip.
Yeah. But a short-term or swing trader looks at the daily chart, sees that momentum exhaustion, feels the institutional weight of that June 23rd gap down, and assumes the entire trend is broken.
Which brings us to the actual tactical battlegrounds. The macro narrative is set. The long-term and short-term trends are literally fighting each other. So where are the specific lines in the sand drawn? Because here's where it gets really interesting for you as a listener.
Yeah, let's drill down into it.
When we zoom into the 4-hour time frame, the H4, the structural breakdown is incredibly precise. We have a clear M pattern formation, which is a textbook bearish reversal structure.
And that H4M pattern shows us the exact anatomy of the buyer's exhaustion. They tried twice to push through localized resistance, right, to form the peaks of the M, but they failed to find the liquidity and got rejected both times.
Right. And furthermore, the price is currently suppressed below the H421 EMA. And what about that June 23rd gap down we discussed?
Ah, yeah. That empty space on the chart is now acting as a heavy supply zone.
Because people are trapped, right?
Exactly. Any trader who was trapped in long positions before that sudden drop is now utilizing that zone to exit at break even. And that creates a massive, invisible ceiling of sell orders.
But there is a definitive floor holding this all up, thankfully. A major demand zone, which also acts as the neckline support for that M pattern, is sitting right at the 28,200 level.
28,200, yeah.
That is the magic number right now. If the market breaks and actually closes below that neckline, it feels like a trapdoor opens. I mean, based on the volume profile, the next major downside target is all the way down to around 27,000.
Yeah, it's a steep drop if 28,200 fails. But conversely, if buyers can somehow absorb this wave of distribution, clear the H421 EMA and push past 30,600, then the daily and H4 charts realign with the weekly bullish structure.
And the pullback is officially over.
Exactly, and we are hunting for new all-time highs again.
And there is a scenario where that bullish continuation happens, specifically when we drop down to the 1-hour chart.
Yeah, the 1 hour is showing something really compelling right now.
We are seeing a bullish harmonic pattern developing right inside a critical Fibonacci retracement zone. We are talking about the 0.786 to 0.886 pocket, which is roughly the 28,500 to 28,700 level.
Right, we call that the golden support zone. And we have to recognize why these specific deep retracement levels matter in today's market.
It's not just retail guys with crayons, right?
No, not at all. It isn't just retail traders drawing lines on a chart. Massive institutional high-frequency trading algorithms are explicitly programmed to sweep for liquidity at these exact Fibonacci nodes.
Exactly. So when the Nasdaq dumps into that 28,500 pocket, it triggers these automated buy programs.
Yeah.
Because the algos identify that 78 to 88% retracement as a highly probable asymmetric risk to reward entry.
Right, it becomes a self-fulfilling prophecy of market depth.
It really does. And if that algorithmic support holds, it could provide the exact bounce needed to attempt to run back up and fill that June 23rd supply gap.
And this is the absolute crux of the current market tension we're seeing. None of these technical setups exist in a vacuum.
No, they don't.
They are about to collide with a massive fundamental catalyst. Every single institution, algorithmic program, and retail trader is currently holding their breath for the upcoming U.S. Core PCE inflation report.
The Personal Consumption Expenditures Index, the Fed's preferred inflation gauge.
That's the one.
You know, I've heard people compare economic data like this to a battering ram hitting these technical support levels.
Yeah.
But I actually think that's the wrong way to look at it.
Oh, yeah. How do you see it?
Well, the Core PCE data isn't a battering ram, it's a gravity switch.
A gravity switch? I like that.
Right. If that inflation data comes in hot, it instantly changes the underlying discount rate for the entire economy. It alters the gravity in the room, Suddenly, the intrinsic value of every tech asset sitting on that 28,200 support line becomes fundamentally heavier, and the technical floor just collapses under the new weight.
That is an incredibly accurate way to frame it, and it raises a really important question about how we synthesize technicals and fundamentals.
Yeah, how do they play together?
Exactly. Technical analysis like the H4M pattern, the Fibonacci liquidity zones, the demand necklines that tells us where the institutional battlefields are located. But the fundamental data, the Core PCE, dictates when the battle happens and the direction of the capital flow.
Because the algos read it instantly.
Exactly. High-frequency algorithms will scrape the Fed data milliseconds before a human can even read the headline.
And if the PCE shows that inflation is stubbornly high, the algos instantly price in delayed interest rate cuts, borrowing costs remain elevated, growth stock valuations compress, and boom, that gravity switch flips.
Yeah, we smash right through 28,200 and cascade toward 27,000 before human discretionary traders can even click their mice.
It's terrifying, honestly.
Yeah.
But on the flip side, if the PCE data shows inflation materially cooling, it gives the Federal Reserve the green light to actually initiate rate cuts.
The gravity lightens.
Yes. That fundamental shift could be the exact spark needed to validate the 1-hour bullish harmonic pattern, bounce the market right off the 28,500 golden support zone, and send the index rallying back to fill the gap and push toward 30,600.
It is a finely balanced powder keg right now.
It really is. So what does this all mean for you as you watch the tape this week?
Well, we are looking at a market caught in a high-stakes, multi-time frame tug of war.
A very aggressive tug of war.
Exactly. The long-term weekly trend remains structurally and fundamentally bullish, but the immediate short-term momentum is firmly controlled by the bears, and that's driven by intense AI margin jitters, shifting supply chains courtesy of OpenAI, and technical momentum exhaustion.
Not on.
The entire narrative of this market, whether we resume the bull run or trigger a painful deeper correction, it literally all hinges on the institutional reaction at the 28,200 support level and the upcoming Core PCE inflation data. And, you know, as we wait to see how the market prices in that inflation data, I want to leave you with a broader long-term thought to explore regarding the fundamental catalyst we discussed at the top of the show.
Oh, about OpenAI.
Yeah. Think deeply about OpenAI's jalapeno chip. If they execute this successfully, if a primarily software-driven company can seamlessly design, deploy, and scale its own in-house inference hardware to bypass traditional chip makers, it sets a terrifying precedent for the broader tech ecosystem.
Oh man, you mean for everyone else?
Exactly. What happens if every major tech giant, from hyperscale cloud providers to social media conglomerates, realizes they no longer need to pay exorbitant premiums for generalized hardware?
They'll just start building their own.
Right. If the entire industry vertically integrates their specialized silicon, what does the semiconductor landscape look like a decade from now? Will today's trillion-dollar market-carrying chip titans be slowly reduced to just legacy, commoditized hardware providers?
Wow.
It's a structural question that could redefine the entire next decade of tech investing.
It really is a completely different paradigm than the one we are trading in right now, and one that requires constant vigilance. Listen, navigating these flashing red and green lights on the market dashboard, balancing algorithmic technicals with shifting macro fundamentals, it is never easy.
No, it is not.
And that's exactly why we do these deep dives, to help you cut through the noise and read the instruments clearly. If you want to continue staying ahead of these institutional shifts with us, please make sure to subscribe and like the video on our YouTube channel, Investor's Edge. Thank you so much for joining us on this deep dive, and we'll see you next time as we continue to track the tape.